Business Diplomacy Today, the podcast about international relations and geopolitics from a business perspective. We help you anticipate the changing political and societal trends that influence your business.
Welcome. My name is Matthias Catón. I'm your host. Business Diplomacy Today is sponsored by the Indo-German Center for Business Excellence. The center is a think tank, research center, and network that connects people and organizations interested in business relations between India and Germany. As an academic institution founded in 2021 at Frankfurt School of Finance and Management, it is independent and impartial, but always close to the real world. To find out more about the center, please go to indogerman.center, and you can also find this link in the show notes. Achieving equality in finance. That's the topic for today's episode, and my guest to discuss this is Mary Ellen Iskenderian. She is president and CEO of Women's World Banking, which is a global nonprofit devoted to giving more low-income women access to the financial tools and resources they need to achieve security and prosperity. Mary Ellen has led Women's World Banking global team based in New York since 2006, and she also serves on the investment committees of two of its impact investment funds. Welcome, Mary Ellen.
Thank you so much for having me, Matthias.
Now, as I said, the title of today is Achieving Equality in Finance. And obviously that title already implies that there is no equality, or at least not enough. So could you outline why finance isn't working for women the way it should be? And while you do that, maybe you can also give our listeners an idea of how Women's World Banking, the organization that you lead, is trying to resolve that problem or that dilemma.
You phrased it quite well, because unfortunately, in every demographic, every country, every geography, every age group, we see that women have less access, thinner or more narrow access to the full range of financial products and services than men do. Globally, we have a gender gap, if you will, in financial inclusion of 6%, but that really masks, that's an average, and really masks some fairly large gaps in some countries. And what is increasingly becoming very clear is the financial services gap is tied very closely to the digital technology gap, and whether women own not just cell phones, but smartphones, since so many financial service providers and other service providers, governments, everyone is designing for apps, is designing for an internet-enabled phone. So at Women's World Banking, we're quite engaged in a couple of ways in trying to even up that gap to address some of these areas of inequality. One is in this access to technology and designing products that not only use digital technology, but address some of the really key concerns of women, the things that might be nice to haves for men, but are absolute essentials for women. We're also working at the policy level, trying to make sure that some of the particular barriers women face, things like discriminatory laws or a lack of identification, or when it comes to gaining access to credit for businesses, collateralization requirements, all of those things can be dealt with on a systemic level. So Women's World Banking is trying to tackle the problem from all sorts of different angles.
So what you're saying is that there is a specific angle of discrimination when it comes to finance, and it's not just a symptom of a general discrimination. So I don't want to give the impression that I don't think it's important, but the question is, you could also say that, well, women are discriminated against in most societies to varying degrees. So it would be surprising if, finance were the only area that would be excluded from that. But what you're saying is that there are some specific factors that contribute to discrimination especially in the financial sector.
Yes, I would agree with your characterization. I think we've started to see, Particularly, I think that the Sustainable Development Goals, for example, have really put shown a light on this. When the goals were first drafted in 2015, financial inclusion, was always seen. It's not an end in itself. It is a means to many other ends, many other of the goals. But it was specifically linked to 7 of the Sustainable Development Goals. At the halfway mark, which we just passed last year, that was revamped, and financial inclusion is now seen as an enabler of 13 of the 17 Sustainable Development Goals. And a lot of that is driven by digitization and the real rise in technological solutions. That lack of access to technology is such a driver of the specific discrimination that you were talking about with relation to finance.
You mentioned digitalization as being a driver of exclusion, but can't we turn it around also? Can it also be a driver of inclusion?
Oh, absolutely. And the pandemic was, a catastrophe on unprecedented levels. But, we really see financial inclusion maybe as having been one of the, the bright spots or the silver linings, because as you saw, so many products and services dramatically shift to digital delivery. You also saw, 240 million women brought into the formal financial system. And it was accomplished largely because so many governments had digitized their relief payments, their support payments during the pandemic. I think probably one of the most startling and telling examples was in India, where the first round of COVID relief payments that were made, right after lockdown, the government made a really interesting decision to make payments only payable to women and only digitally. And so you saw, literally in a matter of weeks, 25 million new digital bank accounts opened primarily by women in order to receive those payments. It's absolutely a driver of inclusion, but I think that the onus now falls on all of us to make sure that all these people who have been included stay in the system and have products and services that are relevant to their lives, that meet their pain points, that address their issues now that they're there in the system.
It's interesting that you mentioned India, and of course the sponsor of this podcast is the Indo-German Center. So we work quite a bit with and on India, and of course the Indians in general, the Indian government in particular, they're very proud of their payment system, the UPI, which is in India, I think, near universal nowadays. So that is certainly a great advantage. Let me stay a little bit with that, because that's a particular way. And you said the government of India made a conscious decision of using that. It's also a public infrastructure. So it's a public system that is open. It's not a privately owned. It's not a PayPal or something like that. It's a public infrastructure thing. Do you believe that that makes a difference? So is there a difference between something that is provided by the state in some way as a public good or a public infrastructure vis-a-vis a private network, be that PayPal or something that is based on, credit card systems and the like?
Well, I think the digital public infrastructure that India has put in place, is just an undeniable achievement and has kind of turbocharged or, really accelerated movement toward inclusion. They've touched on, really all the right things. I think starting with the Aadhaar, the universal identification system, because again, for women, we see, real gaps in terms of identification. Certainly, the numbers I'm still seeing, there are 1 billion people in the world who have no identification, let alone a digital identification. The vast majority of those are women. You still have, many countries that have discriminatory laws around identification. I was reading in Yemen, for example, a woman still is not able to have her own passport. She has to be included on the passport of a man. So that, these issues that are so fundamental, not just to financial services, but to, being an economic citizen. And the Indian digital public infrastructure addressed all of those. Where I'd love to see it go, and where I think, really the sweet spot may lie, is now bringing in the private sector to work alongside, to use those really quite extraordinary rails that the government has put in place, the reliable internet, the ID system, the UPI that you mentioned, but making sure that the private sector uses that. We're working with 3 very large state-owned banks in India, where all of the banks had this mandate to open the Jan Dhan accounts, very no frills, low frills bank accounts that could only take deposits of up to a certain amount and didn't have very many services attached. They all had to open them. The state-owned banks were really, tasked with opening these accounts. But frankly, after I understand that they were in the Guinness Book of World Records for more accounts opened on a single day than anyone else, and yet within a year or so, there were tremendous dormancies, and particularly among women, 55% of the accounts that were opened by women were not being used.
Why is that? What is your assessment? What is happening there?
Well, I think it gets back to some of the things we were talking about, earlier in the conversation. Just there was nothing really relevant. There weren't relevant products for the women or the men, frankly, because the dormancies amongst men were in the high 40s. So it's really a question of making sure that there are products and services that are relevant and that people understand how to use them and they're confident using them, particularly if there is technology involved. So our work with these 3 large banks has been really about engaging and using those existing accounts. And we've found, a couple of real kind of nuggets. I think the most interesting of which is we had a proposition that if the account holder made 6 deposits of an amount that at least they committed to making over a specific period of time, they would become eligible for an emergency credit line. And that combination of, if I establish myself as a good depositor, a good customer, I have access to this funding if I need it, was very, very attractive. The other thing that we're thrilled at Women's World Banking to have discovered is that several of the banks used female agents who came out of the communities that we were trying to reach. And they've been extraordinarily successful and some really important business metrics. They're doing better at both signing up men and women and then converting those signups, again, both men and women, into actual accounts. The balances on those accounts are typically higher than their male counterpart agents. And they've been very effective as cross-sellers, particularly to insurance products. So they're good at explaining the value of those products and then selling them. We were really pleased to see both men and women, but I think some of the comments of the men were quite interesting, that they felt very comfortable asking the quote-unquote stupid question of women, that they might not want another man to know that they didn't know how to use their cell phone, or they didn't understand how compound interest worked, but they were more comfortable asking that question of a woman and then getting the answer from a woman. So we've actually tremendously ramped up our work in building women agents, so much so that the Reserve Bank of India, the regulator, the financial regulator, had set a target of 20% of the workforce in the financial sector in India by 2030 would be women. But when they saw the kind of results we were getting and the real appeal to women as agents and that being a real livelihood, they increased that target to 30%, which had been our recommendation.
When I hear that, on the face of it, it should be very much in the interest of the banks themselves to employ more women, to open more accounts for women, because it seems, they sell better, the delinquency rates are lower, as you said, and I think there's also something that has been discovered a while ago when microcredit became fashionable, that people realized that women entrepreneurs, small entrepreneurs, had a far lower delinquency rates on their loans than men. So technically, from a rational perspective, the companies, the banks that you work with, they should have an automatic self-incentivized to do these kind of things. But still, you said, the state has some targets or the central bank. Why is that not working? Why are companies or banks so obviously working against their own interests if they're not forced to by, for example, a regulator?
Oh my goodness, Matthias, you have just articulated the challenge of my day job, and really why I think it is. Someone once said, if there wasn't a women's world banking created 45 years ago, we'd have to invent one, because it is there's still very much a belief on the part of many financial service providers that there isn't a business case for serving women in general, but even, particularly low-income women. And I do think that the fundamental point about that argument and the way we start that, turning that belief around, is around data. That still in most of the countries in the emerging markets, banks are not required by the regulator and do not report on sex disaggregated data. They don't report how their products are being used by men versus women, which products are being used, where there's more usage. When that happens, there's the real potential both for the regulator to drive certain things, to either incentivize or encourage different types of products, but it's also a tremendous business resource for the banks. And yet we so often hear, even in the countries where they are required to report on sex disaggregated basis, that they don't use that data to make business decisions. So, a lot of what we do, you mentioned in my introduction that Women's World Banking is also an impact investor. And there, where we're a shareholder, when we're on the board, our role is look at your own data. One of the most frequent points that we're challenging at the board level, for example, is managers coming in and saying, the main reason we don't have more women in every element of our operations is they will leave after they're married. Sometimes they'll stay a little longer and they'll leave after the first child. And when we go back and look at the bank's own data, without exception, we have found that may be true. They may be doing that. But their attrition rate is significantly lower than men's. The turnover of women staff at all levels in the organization is less than for men. And if they just looked at their own data, they would have seen that difference.
Yeah, that's interesting. And we men often think of ourselves as being very rational beings, but apparently then looking at the data is too much of an ask. So what kind of companies do you invest in? Is it financial service providers, or what kind of companies are those?
Yes, it is primarily financial service providers. We've made a total of 21 investments between our two funds. The first fund was very largely, as you alluded to earlier, microfinance institutions and some of the traditional partners that Women's World Banking had been working with for many, many years. They were making a decision to become regulated entities, bringing in external shareholders. And frankly, the track record of that shift into external capital regulated entities was really shifting the character of the organizations. We did some research. We looked at 39 microfinance institutions that had moved from NGOs, or nonprofit charitable organizations, if you will, to regulated financial service providers. And at the outset, they had on average 86% women clients. But by 4 years later, they had on average fallen to 59% women clients once they had become a regulated entity, had outside shareholders. And if there had been a woman CEO or a woman board chair of the organization, they were nowhere to be found. And so our investment thesis for that first fund was very much around increasing women clients, increasing or at least holding the ground of women's leadership. Our second fund is also investing in financial service providers, but we have a very, I think we have a very interesting concentration of fintechs. So using that data we were just talking about to drive financial decisions, but also a couple of other companies. We have a wonderful, speaking again of India, we have a wonderful company in our portfolio, an affordable housing finance company that requires women's name to be on the title to the property that's being financed. And in, one go, you have, not only does she gain, access to finance for a home, but she's also got that ownership, that asset that's in her name. And again, all the research shows that asset ownership and empowerment are very closely aligned.
Of course. Yeah. What I notice is that we spoke a lot about India now. There's another example that comes to mind, and I think that was the first revolutionary wave that used technology to empower banking was in Kenya, M-Pesa, which I think has been around for at least 15 years, if not more. Yeah. You probably know that much better than I. So why is it that a lot of innovation in this field seems to be coming out of either developing or emerging countries?
I think that's a great question. And sitting here in the United States that thinks it's on the cutting edge, but is so many developed markets have, these legacy systems, regulatory environments that make it so hard to innovate and to think creatively about, coloring outside the lines. And there's so much that can be learned by what's happening. I had a conversation with a Wall Street Journal reporter actually a few weeks ago, and they were looking at some of the systemic biases that we have in our credit reporting systems here in the US, because it is so heavily regulated. It is such a legacy system. And she was asking me about some of the credit scoring algorithms that we're seeing coming out of Africa, coming out of India, Southeast Asia, and using alternative data to drive credit scoring models. And is there any possibility that some of the more developed countries, if you will, or seemingly developed countries could sort of learn from those models?
How is the discrimination in the financial sector in developed countries, such as, for example, the US, where you're based?
So, it is, as I say, it is very, very heavily regulated. But we see in the US, at least, so much of financial health, financial agency and access, frankly, is driven by the wage gap in the US. We still have, on average, women making about 80 cents for every dollar that a man makes. But as soon as you add race or ethnicity into that equation here in the US, you see those numbers, worsen dramatically. And so that has implications in things like, your listeners may have heard about, student loans are a tremendous drain on so many young people and their ability to kind of get their lives going and buy houses and, sort of move into adulthood, if you will. And women are graduating from college at higher rates, which is fantastic, but they are also they have more than 50% of the student debt in this country. Within 4 years of a professional career, you start to see a widening of that salary gap. We're pretty good here in this country at, starting salaries, but As I say, within 4 years. And so women are 1/3 more slow, if you will, at being able to retire that debt because of the gap. You see, in retirement here in the US, women tend, and this is true in many, many countries, but it hits here particularly, coming in and out of the workforce. So that steady saving towards retirement may be harder to do. They are then making less money over the period of time that they are working, and then they live longer than men. So they've got to take this lower amount of savings and make it
stretch it out. Yeah, which is, on the one hand, it's a good thing, of course, to live longer, but of course, you also need more money in retirement. So it's a double-edged sword. We spoke a lot about banks, obviously, or financial intermediaries, the role that they can play in making access more equitable for women and also minorities, obviously. I think that's also true. When we talk about other businesses, what can they do to help women achieve more financial inclusion, other than, specifically financial players in the narrow sense, such as banks?
Yeah, no, I was so pleased that you wanted to go down that path, because that is actually something we're seeing a lot in our second fund, and really seeing some interesting investment opportunities in something that we're talking about as embedded finance. So you'll have we're doing a project right now. This is on the NGO side, not on our investment activities, but a supplier credit projects both in Southeast Asia and Africa, where you've got many mom and pop shops or mom shops in these countries, where if the fast moving consumer goods company, for example, was making supplier credit available to the store owner, they'd be able to both buy more inventory and sell more inventory. And so we're finally seeing a real understanding on the part of the FMCGs that those shopkeepers are really a viable business, and thinking about the way technology allows them, frankly, to get inside the inventory system of those companies, really understanding what turnover is, what seasonality might be. So in some cases, you don't even have an actual loan being dispersed. It's a payment in inventory that is then paid for as it's sold over time. But the supplier has been essentially inside the inventory management system of that business from day one. One of the oldest models in the world, factoring, I think, is gaining a new life in some of the countries that we're working with. Again, because a small business might have a receivable from a large company that may be notoriously slow to pay. They can put those with an aggregator who understands well what the turnover of that business is, as well as the turnover of the larger business, and is able to finance that smaller company and collect on that larger receivable. So we're seeing, there's nothing new under the sun, they say, but we're seeing technology perhaps allowing some of these solutions to be more democratized and to going down to that base of the pyramid company.
A bold prediction: the world in 10 years.
Mary Ellen, I would now like to get to one of our two segments, namely Look into the Future, where we ask our guests to make a bold prediction, as we call it, and tell us how they think the world will look like in 10 years from now. So over to you.
So I decided to go really dream big on my prediction. But, the financial services industry, banks, insurance, asset managers are leaving $700 billion with a B of revenue every year on the table because they are not selling and providing financial services at parity equally to men and women. And so I'm going to say in 10 years, we have seen the financial services industry finally has a critical mass of women in leadership positions as well as throughout the organization. They understand the huge opportunity that's being missed by not serving women at parity. And so we have much more diverse, much more equal financial institutions, but they're also way more profitable because they're banking customers that they never knew they were missing.
Great. Thank you very much. And of course, it's totally allowed to do a little bit of wishful thinking, but we hope for the best. And it's good to have an optimistic outlook rather than a gloomy one. I think that's always very important. Let me talk about something that we haven't mentioned, because we talked about the role of banks, financial intermediaries. But there is another technology that is sometimes hyped as the panacea, the cure-all for all financial worries. And you already know, I think, where I'm going. It's cryptocurrencies. What's your take on that? Can they help? Is that just a fad, a voodoo thing? Is it helpful for especially the constituencies that you're trying to serve? Or is it a distraction from the real problems? What do you think?
I'd say, a lot of the above.
All of the above.
You just posited. I, as my prediction just indicated, I tend to be a very optimistic person, and I've tried really, really hard to think in positive terms about cryptocurrency and its opportunities for inclusion. But I think where we are now, and at least as far as I can see for the foreseeable future, to put our most vulnerable populations, people whose and if we have not talked about the danger of climate change and the impact of climate and the role of financial services as people are displaced by climate. If we look at this vulnerable population, to put them into a currency that is not stable, is not reliable, that is harder really to understand how it all works. And I believe that the final challenge, the last mile of financial inclusion, is really going to be closed by digital and financial literacy. It's just making sure that people will have access, but they may not use it because they don't understand it. I don't see crypto as being the solution for that immediate problem of understanding and of safety and security. I was in Nigeria in December, and you read about bank failures and the importance of trust, but I was just stunned by the number of women that I spoke to in different markets around Lagos who just had money just stolen right out from under them by insurance companies, banks. That building the trust back is so important, so painstaking, so necessary for financial inclusion. And I just don't see how crypto gets us there. Maybe one day. And I don't think the same thing applies to the blockchain. I think there can be some really important uses for blockchain technology, particularly around identification, particularly around, as I was saying, the world right now is experiencing the highest level of displaced people. And that is only going to increase as civil conflict and climate events take place. So making sure that a relief payment or a remittance payment gets to the one individual person that it is meant to is something that really can be dealt with on the blockchain. But cryptocurrency itself, I have my doubts.
Fair enough. And I agree that it is a sector that sometimes still seems to be searching for its raison d'être. It's, the problem that it's trying to solve, although I think in theory, the idea behind it, of course, is quite enticing. If you had a stable currency, one that would cut out the intermediary, the bank, which even if it behaves ethically, is always any intermediary will always take a piece of the pie naturally. So if there is a way that I could send you some money or vice versa without intermediary, I think that would be good. But obviously, as you said, then if you have something that is very, very complicated and also extremely volatile, then that affects those vulnerable populations to usually a much higher degree than someone who is better off and can maybe afford to lose a few bucks playing around with some of these things.
Executive Briefing, what you should read now.
Let's get to the other part, and we ask all our guests always for some reading recommendations. So we call this executive briefing, because usually we cannot cover everything that is to say about a topic. So if our guests would like to read a little bit more about what we've been discussing here so far, where should they go?
So, Matthias, this is going to be a shameless plug. I am the author of a book that I'm extremely proud of, called There's Nothing Micro About a Billion Women Making Finance Work for Women, published by MIT Press. It's now come out in paperback, so it's a little bit more convenient and lighter. But, all modesty aside, perhaps, but I think it does a very good job of taking you, sort of through the history of microfinance, why microfinance and the model that evolved maybe wasn't entirely as empowering as it might have been, and then what the business case for mainstream financial services for women could be. And then I close the book off with a call to action for all of us, because financial inclusion really is something that governments, businesses, and individuals really can play an important role in. But if I were to point your listeners to another reading, there's a paper that Women's World Banking, Better Than Cash Alliance, the World Bank, the Gates Foundation published first in, I guess it was 2022, called Reaching Financial Equality. And then we did an update last year. And I don't think there's a better piece out there. It has 10 very concrete steps on what needs to be done, from many of the things that we talked about: ID, access to technology and better connectivity, but also things like, changing discriminatory laws and some of the really both concrete and, big systemic issues that have to be taken. I would really urge everybody to not only read it, but maybe identify one of those 10 steps that is something they could really start to make change in their own lives.
Perfect. Thank you very much. And there's absolutely no need to be modest. We've had far more shameless plugs on this podcast than yours. And it truly, I haven't looked at it, I have to admit, but I certainly will. It sounds like a very, very interesting book that you have published. We'll put the link to it into the show notes for our listeners, and obviously also to the other papers that you mentioned. And since you mentioned the Better Than Cash Alliance, I will also do a plug, because we had a similar topic a while ago. That was in episode 11 of the Business Diplomacy Today podcast, where we interviewed Marjolaine Chantreau. Maybe you know her. I think she isn't there anymore, but she used to be at the Better Than Cash Alliance, and we talked about inclusive finance and digital payments as well. So we looked at the topic from a slightly different angle, but with obviously a lot of similarities. So if you, as the listener, enjoyed what we've been talking about today, then maybe it's worth to go back into our archives and dig out episode 11 and listen to that one as well. Mary Ellen, we've come to the end of our episode. Thank you very much for being a wonderful guest, and I wish you all the best for your noble and worthy endeavor. And let's hope that maybe in 10 years of time, we've come to a conclusion. Yeah, you've achieved your goals. We will see, and I wish you all the best.
Matthias, thank you so much. This has been a lot of fun. Really enjoyed speaking with you. Thanks so much.
This was another episode of the Business Diplomacy Today podcast. This podcast is presented by the Indo-German Center for Business Excellence. If you like the show, make sure to subscribe to it on your favorite podcasting platform. And of course, we would also be delighted if you would leave a review or a rating there. You can also go to our website at businessdiplomacy.today to check out the show notes of this episode. And that's it for today. Thanks for listening.